Hi, my name is Alan Seltzer with Verico Complete Mortgage Services, and thank you so much for being part of my first webinar on mortgages. What we will cover on this webinar, first of all, we're going to cover the basics of a mortgage. We're going to look at what lenders are looking for in you. We're going to look at what the process is between me and you and how you work with a mortgage broker. Also, I'm going to tell you how you can get a complete mortgage information package from me, which would be a pleasure to send you. Also, you can have a consultation free with a mortgage expert, me, with no commitment. I'll give you 2 movie tickets for your application or referral from you that results in a completed mortgage application. So either way, whatever results in a mortgage application, it would be my pleasure to send you a couple of movie tickets. First of all, let's talk about what is a mortgage. The root of the word mortgage is mort and gage. Mort is the French word for death, and gage is the Latin word for grip. That's really not true. Mortgage is a long-term loan to purchase a home. Often it's the largest single debt of people's lives, and it can be the largest magnitude of either debt or investments in people's lives. And people often get somebody named a financial advisor to work with them on their investments, no matter how big or small they are, but they'll have a whopping big mortgage and they won't have somebody independent looking after their interests, which is a mortgage broker like myself. You can always use professional guidance as much as you can use professional guidance on your investments. You can use professional guidance on your mortgage. So to get a mortgage, first of all, depends on what I call the 3 pillars of lending. First one is your down payment, the next one is your credit history, and the next one is your income. They're all equally important. Your down payment is your skin in the game. Your credit history is bound to repeat itself, especially the recent history. And your income is really your ability to pay off the mortgage on a regular basis, which is what lenders are really looking for. I get people telling me, oh, I have so much of a down payment, why would the lender care? Well, the lender does care about your income because they don't want to have to chase after you for payments. There's other lenders that'll do that, and even they want to get paid. So let's talk about your down payment. Your down payment, the simplest way of confirming down payment is yours is to show it in your name or your partner's name in savings in place for at least 90 days. Now, that isn't a perfect solution to finding out if that is your money or not, but it's good enough to at least cover many of the situations where this will show that it is your money. If it's borrowed money from somebody like a neighbor or a friend, they usually don't want to lend it to you for a very long period of time. If it's given to you by the mafia, then they certainly don't want to give it to you for 90 days. They certainly don't want to give it to you for more than 90 minutes. So anyway, that's one way. The other way is a gift from an immediate family member. Now, a gift from an immediate family member is very simple. We have a form. Some lenders have their own form, and that is that you and the giftee, you are the giftee, the giftor and you sign that this is a gift and not to be repaid. Over and above that, normally the lender will want the giftor to show that the money was taken out of their account and that at the same time the money was deposited into your account, or they want to show that the withdrawal from the giftor and the deposit into the giftee's account. So here's an example where we have a minimum 5% down payment. The house purchase price is $400,000, and we have a minimum down payment is $20,000, and that is the 5%. Now, mortgage insurance is 2.75%. We'll talk about the numbers a little bit more later on, but that's the amount. $10,450 is the mortgage insurance premium on a $380,000 net mortgage amount. So that $10,450 is added to your mortgage and not paid at the closing of your purchase. So the closing costs, the mortgage insurance is not one of them. So to give you an idea of what your mortgage insurance premiums or cost will be, again, it's always added to your mortgage. At a 5% down, it's 2.75%, and it's $2,750 per 100,000. And at 10% down, it's only 2%, and the 2% is $2,000. So in each $100,000, if you're between 5 and 10%, and you can push it to get to 10%, it always makes sense because it's $750 difference just for that extra amount of money per each 100,000. So take a $400,000 mortgage, it's 8,000 instead of 10 something, so 10,450 or whatever it was on the previous slide. So there's well over $2,000 of savings to you. Actually, 4,000, it's 750 times 4, it's $3,000 difference. So on a 15% down payment, you have 1.75% premium, which is $1,750 per 100,000. Now the biggest drop in insurance premium is when, of course, you don't have to pay any insurance, which is at 20%. So if you're anywhere at 15% or higher, and you feel that there's a way that you could get to 20%, it makes a lot of sense, because look at the $400,000 purchase. Approximately 4 times 1,750 is about $7,000. So you can save $7,000 by getting that extra few $1,000s onto your down payment, which is well worth it. So we're going to look at another example, which is an insurance premium of a purchase price, again, $400,000 with a down payment of $40,000 or 10%. Here you have a net mortgage of $360,000, and that's with a 10% down payment, so you do have mortgage insurance. Mortgage insurance is needed anytime you have less than a 20% down payment, remember on the previous slide. And you're going to pay 2% on the mortgage insurance for a 10% down payment. So $7,200 is the amount of 2% on $360,000, and not the net mortgage, but the total mortgage now is $367,200, and that's what your payments will be based on. So that is an example of a 10% down payment. The next one is, we're going to look at a payment of 20% down where you have no insurance. Obviously, we're missing a couple of lines here because there is no insurance premium. So purchase price of $500,000, just to make a nice round example, down payment of $100,000, you have 20% or more down payment, no insurance to pay. Now, in the case of an investment property where you buy a property that you may want to rent out, the down payment would have to be 25%, which would be $125,000 in that case. Now, as we talked about, no mortgage insurance in these cases. So next is the down payment source, RRSP. Now there is something that the government is doing, the Canadian government, that is called a home buyer's plan. And it's a wonderful, wonderful way for you to increase the size of your down payment by taking out of your RRSP. Now your RRSP is for your retirement, so ideally you don't touch that money, but if you need to, or you want to, $25,000 each, up to $25,000 each partner is how much you can borrow from your own RRSP. Now the word is borrow because you need to pay it back over the next 15 years, or every year 1/15, or any year you don't pay it back, 1/15 of the amount is added to your income. So you may, if you have very low income one year, you may not want to return it back. But obviously any money that you do not return back, and any time that your money isn't in your RRSP, isn't increasing your retirement savings. So it's always a good idea to get money back into your RRSP. One little quick tip is if you have more than the 1/15 per year, it's always a good idea to make sure that you're putting the excess into a different RRSP so that you will get your RRSP deduction again for that year. So let's say you took out $15,000, you're paying $1,000 each year, and you have $5,000 to put into RRSPs. Put $4,000 into a different RRSP, not the one you're paying back. Funds from RRSP must be there for a minimum 90 days before you withdraw the money. So there's also restrictions around when you can withdraw the money around your closing date. So we have to go over those numbers and make sure, those dates, and make sure that we don't break any rules, and that will result in you not allowed to take out this money without tax implications. Because you take out $25,000 and you're in a tax bracket of, let's say, 25%, you could be paying $6,000, $7,000, $8,000 extra in income tax that year. So we want to be careful. See Revenue Canada rules for eligibility, and that way we won't have any problems. So down payment source, we've gone over most of them, but savings in place for more than 90 days. That's easy to show by a statement 90 days ago and today. a gift from an immediate family member that we also went over, a tax refund, perfect example of a source of money that is yours. We prove it by showing the fact that usually on your statement it shows CRA has made that deposit. Sale of a property or asset. You sell a car or a boat or a home, and that money is perfectly good to use even if it closed the day of or the day before you purchase your new property. RRSP home buyers plan we went over as well, and I'd be happy to go over any other asset that you might have or any other source of money that you think you might be able to use. The next thing is credit history. Credit history is, I find, one of the most interesting things of my career, and it basically goes into your last 6 years of detailed credit information. Credit cards, line of credit, auto lease payments are typically on your credit bureau, not all of them, but as a rule everything is there. No companies like TD, CIBC go and put down their mortgages. Trust companies do have everything on there, including their mortgages, but the regular banks do also put their lines of credit. They just don't have their mortgages on the credit bureau. So to help your credit rating is very simple, and it's really logical. Number one, pay your bills on time. If you only pay the minimum, that's fine, but you obviously are going to pay interest if you only pay the minimum. But as long as you pay the minimum and pay it at least within 30 days of the due date, so even if you're a few days late, don't worry, you haven't caused yourself any disaster in your credit bureau. You'd be keeping good care of your credit. Keep balances far below limits. My rule of thumb is 50-60%. The lender sees somebody who has most of their credit cards drawn up to the limit, a very, very bad sign. And it shows that you're not able to manage your credit easily. Why would they give you $200,000, $300,000, $400,000, $600,000 to play with when you're not doing very well with 5 or 10? And don't let too many people check your credit, because it isn't as strong as paying your bills on time or keeping your balances low, but it is something that's gone over by the lender, and if they see that you've gone to too many people, your credit score does suffer, but not a lot. But more importantly, they're going to see a lot of people that you've gone to and wonder why. So if you have any feeling that your credit has a problem, you can go 1-800 to a number to Equifax to find out your credit bureau. It costs you nothing. Or you go to the Equifax website. That costs you $20. If you're doing what I'm telling you that you should be doing, then don't worry about it. You don't need to check your credit bureau. But if you have in the back of your mind anything that you feel you might have had a fight with somebody that you didn't pay through Visa, and it might have been Visa involved in it, it most likely came against your credit. Like if you don't pay a Visa company, not a Visa company, if you don't pay a telephone company because you have a dispute with them, it's wrong. You need to pay it and then dispute it, or even dispute it with Visa, but especially dispute it quickly with Visa to let them know there's a problem, because otherwise it's simply against your credit bureau, against your good credit history. How much income do you need to get a mortgage? That is probably the main question I get asked. And the first line of this chart will give us exactly what you need. In a $15,000 income situation, we can get $100,000, and it will cost you $453 a month. So let's make this really, really simple. For every $15,000, the payments are $500, and the mortgage amount is $100,000. So let's say $30,000, you can get $200,000 of mortgage, and you can get a $1,000 monthly payment. $45,000, you get $300,000 and a $1,500 payment, and so on. So these numbers are approximate anyway, because the rates are going to change. Your amortization may be longer, maybe shorter, but this is just a rule of thumb. So with this rule of thumb, you can go out and not sort of be completely clueless as to how much money you can get from a mortgage. Now, this is with thinking that you have a relatively minor amount of debt. So we'd have to look into more information to get some real numbers for you, but at least if you don't have too much debt, this gives you a very good rule of thumb. Next thing, recent changes that we've had to the Bank of Canada. You could only refinance now to a maximum of 80%. Refinancing is after you own a home, you're only able to re-borrow back up to 80% of the value. We used to go to 95. So imagine a $100,000 mortgage, or sorry, $100,000 value of a property. We were able to go up to 95,000 to reborrow. Let's say you put down a $50,000 down payment, you bought a $100,000 property, you really have 50,000 that's yours. Now you can borrow up to 80,000. So there's 30,000 that you could take out. We're now in insured mortgages, we can only go to 25-year amortization. Now that means that it's a little tougher to get accredited or get approved for the larger amounts of money. Rental suites are now only able to add a certain amount of money to your mortgage. We used to be a lot easier. It used to be a lot easier to add much more for you. But let's talk about that when you're in that situation. Maximum insured mortgages are only at $1 million. Now, in reality, there weren't that many mortgages lent out with purchases over $1 million. The insurance companies were very hesitant, anything over $1 million, just because that's a hell of a lot of money for them to guarantee. Okay, so the mortgage process. Even before you shop, you can get yourself pre-approved. You give me a call, we can have a 10-minute conversation followed by a meeting or a 10 or 15-minute application process and get your mortgage pre-approved within 1 to 2 days. So in our mortgage discussion, the first thing we'll do is we'll have the 10 minutes to organize this, and then 1 or 2 hours we can sit down together or talk on the phone and go over your mortgage options, meaning what lenders do you want to go to? Are you a variable mortgage type person? Are you a fixed term mortgage person? Are you a short term kind of person or a long term kind of person? We look at your income, we look at your source of down payment, we look at your credit history. I will investigate your credit history only with your approval, and we will have something back to you within 1 to 2 days. The important thing is, this is a complete process that I do. Typically, if you go into a branch, you'll have a 10-minute conversation and they'll say, oh no, go ahead and look. And you'll come back and they'll ask you for all the details, and then, oh gee, too bad, you can't get that much mortgage that you need. So I will try to look at it in such a degree that we'll have a 99% chance of success once you find a place and make an offer and have it accepted, which leads us to the next thing. Accepted offer, I'll work with the selected bank to complete the mortgage. So that's really the process. So pre-approval with full review as you start shopping for a new home. Review your income and property once you have an accepted offer. Now, I've already done that. I'm going to ask you for all that information, and I'm going to make sure that when you do have a live offer, we're going to send this information to the lender and have 99% success rate. Financing subject to remove once passed. Now the lender is going to come back to us, either ask us for more information or accept the information that we've sent them. So the next step is you remove subjects, and now we have what's called a ducks in a row call to the solicitor 1 week before closing. Solicitors normally don't hear from the mortgage broker at or near closing. I don't work that way. I want to make sure that right through to the closing date or completion date that you're covered and you're informed, and I get you all the information. I make a request for the statement of adjustments and the land title form B, which I ask you to request from your lawyer and send to me. So number one, I have it in my file. If we ever talk about your mortgage again in the future, which would be a pleasure. And number two, I check to see that the lender sent all the information correctly to the lawyer. So I call that my ducks in a row call to the solicitor. And solicitors have a whole lot of different responses to this call. It's either, wow, that's incredible, I usually don't hear from mortgage brokers, to why are you bothering me, and followed by, oh my God, we need instructions, can you help us? So it's a very interesting call, and that's one of the things I really love to do, because I want to make sure the lawyer has what they need, and I want to make sure that you have the most stress-free closing, signing, I should say, at the lawyer or notary. Closing or completion day, congratulations, you own your own home. One question I get quite a bit is, should I go to a notary or a lawyer? Really up to you. They both do the same thing. The only difference is if you have a fight, the lawyer can fight a fight, notary cannot. They'd have to give it to a lawyer. So we don't have fights very often because everybody wants to do what you're trying to do. But if you like to cover yourself completely, a lawyer can do more. Lawyers are not necessarily cheaper than notaries, and notaries aren't necessarily cheaper than lawyers. So do your due diligence, ask for the fees, taxes, and disbursements when you go and check pricing for a lawyer or notary. So let's see who you should work with here. Okay, that's my team, and there's the bank. So I do a credit history. Typically, banks will not do the credit history on the pre-approval stage. I examine all information and make sure that you have a 99% chance of making your deal work with the lender once you have a live deal. Typically at a branch, as we talked about earlier, you have a quick conversation and that's it. I can recommend one of 40 different lenders. That's me. Banks can only represent their own product. If they have, I do home buyers classes, and I always talk about the fact that if TD, you're sitting down at a TD branch and they know that there's a product that's perfect at Scotiabank, they're not going to tell you, you know what, get out and go down the street and go to Scotiabank. They're going to give you the product that's the best for you that they can provide. It's pretty natural. I have 40 different lenders that are looking for your business, so I have pretty much the market to be able to offer you whichever is best for you, not necessarily for me, or certainly not for me. Accumulated all documents that will be needed for a live deal. I do that right at the beginning. This is a process that is time consuming and costs money. I do it. Branches usually just want you to come back with everything once you have a live deal, which is now you have a much better way or much more chances of closing. You're probably 50 to 80% will close. Update and switch lenders if in your best interest. I can do that. A lender, of course, who only has their own product cannot do that. At the live deal, so you send in and fill out the package of documents we need for the lender. I sometimes have most of it. The branch, of course, will review your documents as well. Make sure lenders will go forward or change lender. Again, bank only has one option. They can only say yes or no. We can do that. We have a failure with one lender, which is unusual. We will find another one if it is possible. We often have many options with different levels of rates. That depends on your situation. We'd go from the best rate, obviously, to the higher and higher rates if we needed to and you were amenable to it. I'm available on your time schedule. Bank hours are, you know, when I was a kid, bank hours were a joke because they were 10 to 4. Today they're a little bit longer, but I'm available anytime. Follow up on the lawyer to make sure all is in order. This is what I do. This is my ducks in a row call, if you remember on the last slide. And I love the response, and I love being involved with your deal right to the end. That's it. Thank you very, very much for listening. It has been a pleasure, and good luck on your home search, and it would be my honor to work with you. My name is Alan Seltzer with Verico Complete Mortgage Services, 604-202-7114. I look forward to hearing from you.